Many students lose marks in cost questions not because of diagrams, but because cost concepts are weak. So today, let's focus on understanding cost properly. In this video, we will begin with explicit and implicit costs, then we will move to fixed cost and variable cost in the short run, and finally, we will construct a numerical cost table and graphs, which would also be the foundation of these curves. Cost in economics does not simply mean the total money spent on producing a commodity. Economic cost includes both explicit costs and implicit costs. Implicit costs also include normal profit, the minimum return required to keep the entrepreneur in the business. Economic cost is broader than just expenditure. Explicit costs are actual money expenditures made by a firm. These are payments made to outsiders for hiring their services. Examples include wages paid to labor, rent for the factory, expenditure on raw materials, and electricity and fuel bills. These costs are easy to record because they involve direct cash payments. They are also known as accounting costs. Now let's understand what are implicit costs. These do not involve direct monetary payment. They represent the estimated value of inputs supplied by the owner to the firm and also includes normal profit. For example, the owner's unpaid labor, the use of one's own building, or the use of one's own capital. Even though no money is paid, these are real costs in economics. So far, we have seen two types of costs in economics. When we add only explicit costs, we get what accountants call accounting cost or money cost. Economic cost includes both explicit costs and implicit costs, including normal profit. This distinction is extremely important in exams. If you want a quick revision of this difference, I have explained in a short video using a real-life example. The link is in the description. Now that we are clear about what cost means in economics, let's move on to how costs behave in the short run. In economics, the short run is defined as a period of time in which at least one factor of production is fixed. This fixed factor could be a factory building, machinery, or land. Because one factor cannot be changed in the short run, firms cannot adjust all inputs freely. As a result, some costs remain constant while others change with output. This is why in the short run, we divide costs into fixed costs and variable costs. Fixed cost is the cost that does not change with the level of output. Examples include rent, insurance, and salaries of permanent staff. Because fixed cost remains constant, it does not depend on how much is produced. It is incurred even when output is zero. Variable cost is the cost that changes with the level of output. Examples include raw materials, wages of casual labor, and fuel and power. When output is zero, variable cost is also zero. As output increases, variable cost increases. These costs are directly related to production. So the key difference between fixed cost and variable cost is simple. Fixed cost remains constant while variable cost changes with output. Now that we are clear about fixed cost and variable cost, we can bring them together. In the short run, we study three main cost concepts: total fixed cost, total variable cost, and total cost. Total cost is simply the sum of fixed cost and variable cost. This formula is frequently tested in exams, both numerically and through diagrams. This table shows how costs behave in the short run. Output is measured in units. Notice that total fixed cost remains 12 at all levels of output. Even when output is 0, fixed cost is still incurred. Total variable cost is 0 at 0 output. As output increases, total variable cost also increases. This is because variable costs change with the level of output. Total cost is calculated by adding total fixed cost and total variable cost. For example, at 0 level of output, total cost is 12 plus 0, which is just 12. At 1 unit of output, It is total cost is 12 plus 6, which is 18. So this table clearly shows the relationship that total cost equals total fixed cost plus total variable cost. Using this same table, we can now derive the short-run cost curves. Here we are deriving the fixed cost curve. From the table, we can see that total fixed cost remains constant at 12, regardless of the level of output. When we plot output on the x-axis and fixed cost on the y-axis, we get a horizontal straight line. This is because fixed cost does not vary with output. In exams, you should write it like this, that the fixed cost curve is horizontal because fixed cost does not change with output. Next, let's derive the variable cost curve. From the table, we can see that total variable cost is 0 when output is 0. As output increases, total variable cost increases. When we plot output on the x-axis and variable cost on the y-axis, we get an upward sloping curve. This is because variable costs change with the level of output. The variable cost slopes upward because variable cost increases as output increases. Now let's derive the total cost curve. From the table, total cost is calculated as total fixed cost plus total variable cost. At 0 output, remember total cost is not 0. That is because fixed cost is incurred even when output is 0. When we plot output on the x-axis and all three costs on the y-axis, we can understand them better. The total cost curve lies above the variable cost curve. So the total cost curve is simply the variable cost curve shifted upward by the amount of fixed cost. The vertical distance between the total cost curve and the variable cost curve is nothing but actually your fixed cost. Many students wrongly draw total fixed cost starting from the origin. That is incorrect. Why? Because total cost never starts from 0. Fixed cost is incurred even when the output is 0. So now using the cost table, we have derived the fixed cost, variable cost and total cost curves in the short run. Now you know how to avoid the common mistakes students usually make in exams. Remember, just drawing the correct curve and describing the shapes is not enough. If you do only that, you will lose out on marks. Always explain why fixed cost is horizontal or why VC curve slopes upward. Let's quickly recap the short-run cost curves. In the short run, total fixed cost is horizontal because it does not change with the level of output. Total variable cost slopes upward as producing additional units becomes increasingly expensive as output increases. The total cost curve lies above the variable cost curve and the vertical distance between TC and TVC represents total fixed cost. This relationship is exactly what examiners expect you to explain clearly along with correctly drawn diagrams. If you want to learn how to draw the graphs neatly and accurately in exams, I have explained that step by step in my video on how to draw graphs in economics. Link is in description. Here is a quick exam shortcut. At any level of output, the vertical distance between the total cost curve and the total variable cost curve is total fixed cost. Notice that this distance stays exactly the same as output increases. Examiners often test this visually, either by asking you to identify TFC from a diagram or to calculate it as TC minus TVC. In the next video, we will learn to derive AFC, ABC, ATC and marginal cost all from the same table and then plot their curves step by step and understand the reasons behind their shapes. Want to score better? I can help.